Americans from every walk of life unite in our resolve.
Mr. Gorbachev, tear down this wall.
Congress passes the most sweeping civil rights bill ever to be written into the law, and thus reaffirms.
All step for man, one giant leap for man.
It specifies the unconditional surrender of the past.
Gasoline engines, the Wright brothers took to the air. The world soon followed.
May, indeed, will be called the electric age.
407 years ago, our fathers brought forth from his country
To form a more perfect union and justice.
In the course of human events, it becomes necessary to
declare that these united colonies are, and of right ought to be, free and independent states.
Welcome to the last full panel discussion of the day before our closing keynote. We're going to talk about some business models that have evolved significantly in the past few years, namely embedded banking, payments innovation, and digital assets. Not only are these business models not novel anymore, but the heights to which these models can climb has gotten really incredible. So back in 2020, I connected with Stride Bank and profiled them. At the time, they were doing about 26,000 ACH transactions per month. Today, a few short years later, that is 2.5 million per month, worth $1.5 billion. So the landscape has fundamentally changed. The fintech grow-at-all-cost era is over. We've also seen a lot of regulatory scrutiny in these spaces, and so I've brought my friend and former colleague, Emmett Shipman, on the stage to help us with this panel. He's responsible for growing fintech strategy practice at accounting and advisory firm Wolf & Company. Help us navigate some of that discussion as a co-moderator today. But really, these spaces are just evolving, and so we're going to talk about what that means for your bank and whether some of these models may or may not be right for you. So to kick us off, let's start with some brief introductions from our esteemed panel of experts. I'll let them introduce themselves, and Jimmy, maybe we start with you.
Sure. My name is Jimmy Stallings. I am the president of the payments group at Stride Bank, and I think Amber did a pretty good job of giving you a little background on us. So thanks for having me.
Chris?
My name is Chris Lane. I work with a small advisory firm called Invictus Advisors. I consult with banks right now in the digital asset, at the intersection of digital assets and fiat. I spent 15 years at Silvergate Bank on the payments and operations side of the business. So had slightly more than a, what was the term earlier?
Brief flirtation.
Yeah, it was slightly more than a brief flirtation with crypto. We'll talk a little bit more about it.
Hi, Vinny Rezavker, Director of Bank Partnerships at Unit. Been with Unit for about 4 years. Before that, held a number of compliance positions at Citigroup, UBS, and some prepaid companies. And just wanted to thank Travillian for having an event here in Philadelphia. I'm local, so go Phillies.
And Emmett.
Awesome. Well, AB, thanks for having me. Amber and I were co-workers at Alloy Labs, and it feels like the good old times. So Emmett Shipman here. As Amber mentioned, I'm helping grow our fintech practice at Wolf. We are a 114-year-old tax audit advisory firm based out of Boston. And what got me excited to join was sort of this idea of the embedded trust that Wolf has had in the industry for over 114 years, and how can we take that embedded trust and create a strategic layer on top of that to sort of take these novel ideas and these innovative technologies to the next level.
All right, and with that, we will dive right in. So Jimmy, in our prep call, you mentioned an interesting evolution that's kind of occurred that I'd love to dive more into. There was a distinction that you've seen arise between fintech partners that are primarily providing financial services versus the new crop of embedded finance partners, which are oftentimes Fortune 100 companies that are really just trying to leverage existing customer bases and bring financial services within the realm of what they offer. Can you walk us through why that difference matters?
Sure. When you look back 5 years and you look at the emerging neobanks and kind of the financial services that they had built a company around, they often mirrored banks in terms of the back office, the risk and control and compliance measures that they were aware enough to know that that was going to be a focus of their business because it was a focus of the banking industry and the bank partnerships. When you look at Fortune 100 companies who often don't offer financial services but have a large customer base that's readily available, and they see the ability to not only do customer attraction and retention, but also generate revenue from the financial services model. That's customer acquisition has always been one of the big costs for the neobanks and the traditional fintech. So you're kind of cutting that out. What you don't have, though, is a business that was built around traditional banking. So these companies will come to us and they'll say, we want a card program. And we say, okay, great. What kind of card do you want? And they'll say, well, what kind of cards are there? So you kind of start with that, and you start with the education about debit, prepaid, secured credit, unsecured credit, and then you have to start saying, okay, now do you have a compliance officer? Do you have? And they'll say, sure, we have a compliance officer. And we're like, okay, but do they know anything about banking? Yeah. So it's really kind of, and then you start to get into other facets of fraud monitoring, customer service, where they have kind of, well, sure, we have customer service, but are they used to answering questions from a customer at a banking regulatory level? And so I think the next, to me, the next evolution is being able to solve the problems for the larger companies that don't necessarily have the banking infrastructure that we've seen come out of the neobanking space.
That's really helpful. And I know you work with fintech clients on the risk and compliance side, so this seems to tie directly into what Wolf is kind of helping these companies navigate. Are they prepared for the kinds of questions that someone like Jimmy is going to ask?
Yeah, it's such an interesting culture clash in a lot of ways, right? Banks are trained to be risk averse, and fintechs tend to be sort of risk ignorant, and so that's where Wolf can kind of come in and help sort of get the puzzle pieces to fit properly. And so that's where we've been spending a lot of time, or at least me strategically, thinking about putting my mind and putting myself into the founder's head and saying, what are they focused on, right? They're looking for scale. They're looking to hit their next tranches so that they can, raise their next round of funding. So strategically, risk and compliance should be the fourth pillar of their go-to-market, right? Sales, marketing, and product are what they're really good at. Let someone like a Wolf come in and be that fourth strategic growth pillar of risk and compliance. And so that's what we're really focused on these days.
And Vinny, this ties directly with what you do at Unit. When you have like an Etsy or a Toast come to you and say, we want to work with a bank, we want to get more from the financial products that we can offer, what kinds of discussions are you having with them, and kind of questions that you're walking through with those folks?
Yeah, at the end of the day, what Unit does is we're a technology company that allows companies like Toast, who is a client, and hopefully one day Etsy, to offer the banking services using our digital core. We're big believers at Unit that we like to make sure that all the parties involved focus on what they do best. We let the bank do the compliance oversight and risk management and provide the banking services. We let, as Jimmy said, we allow the companies to focus on marketing and customer acquisition, and we at Unit, we provide the technology that allows them to connect through our digital core. When they come to us, and as Jimmy said, we are seeing a lot more Fortune 100 and vertical SaaS companies rather than just traditional fintechs or neobanks. We one of the first questions we ask is, which path do you want to go down? Because we have two products that we can offer. One is the custom build, where the fintech or vertical SaaS company can build out their banking solution however they want it and connect to and offer the banking services through APIs. Or we have a new product called Ready to Launch, where Unit actually steps in and takes on some of the responsibilities like marketing, customer support, fraud losses, and InfoSec. And it really even more so allows the Etsys and Toast to not have to go out and build this banking team within their company, but just focus on what they do best. And so we always want to make sure to allow companies to do that.
So one thing that I think is pretty present just in the industry and in this particular segment of technology is kind of the wave of consent orders and issues that we saw come out of banking as a service, and not so much embedded finance, but definitely kind of the early BaaS providers. And something that Jimmy said in our prep call that was really interesting was that the banks that have gotten in trouble, it's typically because they forgot that they were the bank. So what does it actually mean to remember that you're the bank when you are partnering with these sometimes very large companies and corporates?
I think from our perspective, we've always viewed an account, whether that was opened through a fintech partnership or organically at one of our branches, as an account's an account. And it's our job as the bank to be able to service that, service in the sense of reconcile those transactions, make sure that the statements are correct, whether we're using a fintech partner for the actual face-to-face servicing, it needs to be handled the same way we would handle any traditional account at our bank. And so I think what happens when some of these companies and banks started to scale and they got very focused on the technology they were using, they almost lost the basic tenets that we have as bankers of it's your job to reconcile. You need to know where every one of those pennies in each one of those accounts exists, and even if you don't have the ledger internally, you better have access to it. And at the close of every day, if somebody were to literally vanish tomorrow, but when I say somebody, one of those partners, you better be able to get the customer their money. And I mean that's kind of core banking 101. And so when you see the deviations, and that's where I think a lot of the banks got in trouble, was, again, they kind of got wrapped up in the technology. And in my opinion, regulation shouldn't necessarily be like a taxation on innovation, but it should be literally your license to innovate. It's, we trust you enough, as a bank. Now, if you want to go out and provide those services at a digital, capacity or a more forward-thinking way, that's great, but you need to remember you're the bank and you're the regulated entity first.
Yeah. And the technology is so exciting sometimes. Chris, I know you worked with a lot of crypto companies in your day, and you advise banks now in similar spaces. Have you seen anything that you could add to that discussion about how banks can think about themselves and their role as perhaps separate from the tech?
Yeah, I'll say embedded banking and BaaS is a challenging business. I think maybe taking a step back, what you said, Amber, a few minutes ago, and talking about Stride's scaling of their payments volume. That's something I think probably most of the bankers in this room, to the extent they're familiar with the Silvergate story, they probably see the explosive balance sheet growth starting in 2019, 2020. What's not apparent for most people is I think we actually entered the digital asset banking space, providing traditional banking services to digital asset customers in 2013. I think I gave a presentation to who essentially the head of the San Francisco Fed and some other people there on what is Bitcoin in 2014. And then we methodically scaled. Our payments volume was probably akin to what Stride was back in 2020. We continued to grow that payments business, and we were able to do that primarily because we listened to our customers, and not what they were necessarily asking, but listening to what their data was telling us. So looking at the funds flow between the customers, we were banking a nascent ecosystem, understanding how the money was moving in that ecosystem, and then figuring out who else we need to bank in order to essentially build our internal payments network that would have been a great foundation for a tokenized deposit network. And I know we'll talk stablecoins and tokenized deposits here in a few minutes. So
yeah, oh yeah, we're gonna get there. Don't worry, guys. And Vinny, I know, speaking of that moonshot growth that people see on the balance sheet, I think we talked in our prep call about how a lot of institutions may come at this with a mindset of it's like a get-rich-quick scheme kind of thing, that you can just jump in and get all these great partners and grow your deposits like magic, right? But it's not. I think you said it's not a side of the desk proposition, these business models. Can you say more about that?
Yeah, absolutely. So, if a bank wants to get into embedded finance, they really have to focus on three things and have them. It's commitment, resource, and vision. In terms of vision, it has to be part of the strategic plan of the bank all the way up to the CEO and the leadership team. It can't just be, a small fintech division or one person running a fintech team. It has to be something that the bank wants to do as part of its strategic growth. Then in terms of resources, you have to be ready for the work that it takes to run this program. You have to have automated transaction monitoring. You have to have the proper staffing to meet with clients, service the clients, work with the technology provider like Unit. And finally, the bank has to have commitment to the space. You're not going to see revenue on day one. There is a process of ramping up the revenue as you're bringing clients along. And also in terms of commitment, you have to be ready for growing pains. Sometimes you'll get a client, and that client, for one reason or another, leaves, or something. We continue to always improve on our technology, and so when you pick that provider, you have to be ready for growing pains, but you also want to pick a provider that turns those growing pains into lessons learned and improves on their product. And we've been around for 5.5 years, and the way that our technology and our product looks today in terms of what we do, not just for the fintech clients, but also for the banks, has grown tremendously. And sometimes that comes from the growing pains that come along with being in this business.
Yeah. Picking up on that first theme, commitment, right? I remember, so Jimmy and I are Oklahomies, as I like to say. We both live in Tulsa, Oklahoma, and back when I was writing that article for Bank Director Magazine in 2020, I spent a couple of weeks inside the bank. I met all sorts of people at all different levels, and what struck me was just the sheer level of investment, even back then, before Chime went live, right, that you had to put in. I mean, you had, even back then, 9 people in AML alone, general counsel, connections to 8 different payment processing networks, which is a huge commitment when you consider your asset size at the time was, a fraction of what it is today, to say the least. So how do you advise peers that are thinking about infrastructure investment versus expected returns?
So I think that I think Vinny's comment is spot on. You have to have a commitment throughout the organization. It starts with your board. We ran really, really high efficiency ratios for a lot of years, building the foundation for what we were able to scale. And it's culture of compliance. You've got to have legal in place, and you certainly have to have the risk infrastructure. And it doesn't necessarily mean you have to have all of the people there. I mean, you need people in those places, but we've certainly grown. You talk about 9 people in AML now. I think I've got 40.
Wow.
So, I mean, it's been one of the higher growth areas, and we've had to commit to FTEs, but we were able to do that at scale, as the programs grew. But we had to have the foundation and the infrastructure to start. And so that, to me, is the thing that you're going to commit to it, and depending on, and there's, Unit has an approach, we had a different approach. There's a lot of different ways to get there, but you have to have a commitment, you have to have a strategy, and you have to be able to scale that. And so if you go into it thinking it's a one-off deal, it just doesn't work right.
Yeah, when we were at early days of Alloy Labs, AB, I remember it was sort of like a Bazapalooza. Like everyone was just like rampant. And probably to take the metaphor too far, like there was a big hangover, right? When those that weren't committed, that saw the shiny object and chased it. But I'm feeling that the fintech winter has thawed or is thawing, and I'd say it has thawed. And I read recently in a QED BCG report this phrase that stuck with me since I read it is, fintech is no longer grow at all cost, it's about profitable growth. And for me, that means responsible growth. And we've had, since I joined Wolf 6 months ago, we've had a few banks approach us and say, Jonah mentioned it on the panel before, like if you get your risk management down, this is a huge opportunity. And being, asked to sort of help banks think about how they need to be creating their frameworks and structures to have a meaningful program is pretty interesting.
It is. And to that point about infrastructure, another thing that came up on our call was payments infrastructure alone. I know, Chris, you feel pretty passionately that whether a bank is thinking about digital assets or not, they need to have their payments layer in order. Can you tell us more about that?
Yeah, absolutely. So I actually just recently co-authored a paper on the integration of Bitcoin and commercial banking. And the principles apply to stablecoins and tokenized deposits as well. But at the end of that paper, I present a technical architecture, a reference technical architecture, and I make the point that the no regrets move for every bank that will be here 5 years from now. And if you're planning to sell, sure, you probably don't need to do this, but every bank that's going to be here 5 years from now should be updating its payments infrastructure today. If you look at what a stablecoin or a tokenized deposit network is, it is a real-time push payment network. It is akin to RTP or FedNow. I would not be surprised to see RTP roll out a consortium tokenized deposit in the next several years. I would assume the vast majority of the banks in this room, if you have done either RTP or FedNow, you're probably a receive-only bank. You probably have a connector with your core provider in order to be able to receive those payments quickly, so that way you're not the stodgy bank that can't receive a real-time payment from the fintech or from one of the larger banks. That model is going to play out with stablecoins and tokenized deposits, assuming when the dust settles 12 months from now, whether it's Stripe or Circle, whichever one of those gets retail adoption, the adoption path into the banking system will be similar to RTP and FedNow. You need to be able to receive only. To the extent you want to be a fintech enabling bank, or you have a large retail customer base that wants to send those sorts of payments outside, the payments hub layer is the right way to do it. You should not be essentially having point-to-point integrations with each of these ASP solutions that your core provider is providing. I'll leave it at that.
Just at that, yeah, no, not difficult at all. Yeah, go ahead.
I just want to say, so it's actually one of the things we did at Silvergate in 2018, 2019 timeframe. We were one of the first banks to bring the Finastra payments hub down market in the US. They call it Global Pay Plus. It runs in the largest banks around the world. There were a couple of banks that were ahead of us in terms of implementing that payments hub in the US community regional banking market. We started the implementation after all of them. We went live before them on Fedwire. 3 months later, we went live with Swift on that same payments hub. And when we were looking at tokenized deposits and stablecoins, we were not implementing a new system. We were connecting it to that payments hub. So that is the path for integration for digital assets into a bank, is the payments hub. Okay.
Lots of partners in that discussion. It sounds like, Emmett, it's the perennial build versus buy versus partner scenario.
Yeah, right, build, buy, or lease. And what's interesting on the payments hub piece, as I was closing out my time at Alloy Labs, we had 20 banks fund a payments middleware, a payments hub of sorts, right? And it can be done. It's hard, but if the infrastructure and the differentiation is there, payments was a piece of infrastructure that Alloy Labs was trying to tackle. Identity was another one, right? With all the fraud out there, and I think we'd rather have our identity owned by trusted community banks than by Stripe or Plaid or anything like that. But yeah, I mean it's the age-old question, and at the size and scale of several community banks. I've been bullish on the partnership angle for a long time, but if it's strategically differentiatable, then I think there's a case to build.
Yeah.
So here's the hard part, and I don't mean to be critical about this, but especially with stablecoin, I'm having a hard time understanding the value proposition for the bank. I can understand it from an account acquisition and retention, and maybe customers drive us to that.
Yep.
But I don't, unless you're doing cross-border remittances, do not see the value proposition that a bank would have in tying up their balance sheet with stablecoin.
Yeah.
So how do you think that
So
evolves?
you do not want to be in a situation where there's two things to avoid. One is just not being able to receive it. So your client, your consumer client, has a friend that wants to pay them back for dinner, and they're using Circle, or so they're using Cash App, and Cash App has Circle in this scenario, and your client can't receive it. That's annoying. It makes them think they've got a bank, that's not tech forward. What you want to be able to do in that scenario is take that incoming stablecoin and convert it to deposits very quickly and move on.
Yeah.
That's,
off-ramp.
Yeah, exactly. And you clear it back. Think of it as a check. You receive that incoming, you're going to send it back to the issuer through some sort of clearing process. Mm-hmm. And I do think you wait 2 years, Fiserv, FIS, Jack Henry, they're all going to have the connectors for you to be receive only and not have to do the brain damage. It's only if you want to do the send side that you're going to have to actually, get in there. And
so we've heard from clients and prospects on twofold. One that had the strategic conversations internally where it made sense strategically, whether it was thousands of international wires that they were doing. The other one that I'm hearing more often is board mandates, like figure this out.
Yeah.
Right? It's not a problem now, but with the legislation in place, the market, the use cases, and the technology, it's all going to converge. And our hypothesis is you have to at least be planning for it and understand where your strategy aligns to it, so that you can capitalize when those three sort of monumental levers converge.
Agreed. Yeah, and on the bank side, I think if you if you're sending money out and you want to be able to do it in a tokenized manner, you can, I think the example you just gave, if you have a strong remittance flow for your customer base, there might be some sort of like, someone calls it a DeFi sandwich, I don't where it's basically fiat on one side, you use the stablecoin network to, to transfer, and then you convert back to fiat on the other side. That's one option. The other option, as a bank, you have the ability to issue a tokenized deposit, is it okay to jump into that now?
Let's do it. We're at the Genius
All right, I've got
Act.
2 minutes to explain to you the difference between a stablecoin and a tokenized deposit. And realizing that most people in this room probably don't really know in detail either, let me just set this principle. So a stablecoin and a tokenized deposit, think of them as technically similar or even possibly technically identical. They're both tokenized representations, or tokenized liabilities that represent assets on somebody's balance sheet. They can both be issued on public or private blockchains. They can both have all of the same controls that you need in order to stay compliant. So how are they different? So with the Genius Act that just passed, we know a payment stablecoin issuer is likely a fintech or a payment processor. They're issuing this token that's very similar to a tokenized deposit, but they're not a licensed depository. So the asset side of that balance sheet, according to Genius, is commercial bank deposits. So it's deposits sitting with all of you, and it's treasuries, or it's basically high quality liquid assets. That's the asset side of that. On the bank side, if you want to issue something that interacts in this manner, you could back it with high quality liquid assets, but I don't think that'll be great for your NIM. I think what you will do is issue a tokenized representation of your balance sheet. It'll be backed essentially by the loans, by the cash that you have at the Fed, by your investments. So again, technically, think of them as very similar. The difference is the issuer and the reserve makeup. And then one other point on the difference between the two. As a stablecoin issuer, you cannot pay the interest out to the, under the Genius Act. Interest cannot be paid to the end user. And there's potential loopholes that people are talking about in terms of like rewards. But on the deposit side, you can issue a tokenized deposit that technically is the same, and you can pay interest on it. So that's the way things sit right now.
I've heard a lot of, it seems to be very binary. It's like Hatfield and McCoy's, either you're team stablecoin or team tokenized deposits. Why do you think that that's the case, Chris?
Can you elaborate?
I feel like when I'm talking to banks, they're either all in on stablecoin or all in on tokenized deposits.
Yeah.
And there doesn't seem to be a lot of.
If you're talking to a bank that's really interested in stablecoin, they probably have an interesting remittance flow where they're going to be able to take more FX, or they're going to be able to save money on the actual transmission. I don't see a reason why a bank would issue a payment stablecoin other than that. And even in that scenario, you can do that without issuing it. But again, like if you're a bank, you likely are not going to want to constrain the asset side to high quality liquid assets. You're going to want to treat it like you treat any other deposit.
So go back to when you talked about the stablecoin, the high quality liquid assets. I understand that concept of custodian stablecoins. On the digital asset side, though, when I'm actually digitizing parts of my balance sheet, are there specific requirements about what assets are and are not able to be used as a digital asset? I mean, consumer lending, right? If I got a revolving credit card portfolio, is that just as good as a 1-4 mortgage?
Yeah. So the concept of tokenized real-world assets, I think it's even more complicated than what we're essentially tokenizing the asset side more directly. I think there's probably some legal ambiguity on the tokenized tokenized deposit front. But we are seeing banks make announcements in this space. I think BNY Mellon, small little shop up in New York, I think announced a couple of days ago that they were going to be, they're exploring tokenized deposits. So I think it's a pretty good indication it's coming. And frankly, I would not be surprised to see a consortium like the clearinghouse issue. And RTP is 10 years old now. I would not be surprised to see them issue a tokenized deposit and spread the deposits, in their joint account on the back end.
So just briefly, are we all on the same page? Do we have questions? Not to go too far down the rabbit hole, but we are here to learn, so I want to make sure everyone feels good. Okay. All right, so it sounds like one of the questions that we need to tackle is, do you want to issue or do you just want to receive? Very similar to the real-time payments networks and that whole exercise that a lot of banks went through recently. Any thoughts on that?
Anybody?
From anyone?
I'll say, go ahead.
Well, I guess broadly, what I would tell you is, Chris mentioned RTP and FedNow, and we haven't seen huge adoption on FedNow because the big banks aren't doing it. But I think as soon as Chase starts, accepting FedNow, then it's going to get pushed down to all of us. And I would guess that you're going to see the same thing on the tokenization and digitized assets, is that when you come up with a big bank that has cool products and all of a sudden their consumer base is using it, it's going to push it into the rest of the banking ecosystem, would be my thought.
I think that's right. And most banks in that situation would be able to participate as a receiver in that sort of a scenario. And frankly, they could even be a sender. You don't have to issue in order to send. I mean, it's just a more technical integration. I think a very small number of banks will issue their own tokenized deposit. Potentially a larger number will participate in a deposit consortium. And the fintechs will continue to, I think, go down the payment stablecoin route, and to the extent they get adoption, banks should just be ready to interact.
And I would tell you the biggest issue banks are going to have is liquidity, because it's going to change the way we manage liquidity in our banks. And I think none of it, and actually you could probably make that statement for a lot of industries that rely on float. The insurance industry is going to change. When you start real-time money movement, I mean, it's just like when we move from checks to credit cards, or debit cards, and now you're going to take it and make it even faster. And so the 24-hour or 7-day accounting process that banks are going to have to move to be able to do settlement and reconciliation, those are not small things for banks, especially a lot of us with antiquated cores. So it's going to be a change that we all need. I think that's maybe your point, is that 5-year window. You better start getting ready now, because you don't want it on top of you and have not prepared.
Yeah.
Well, and the refrain that we've heard in some of the high-level conversations is they see it as a defensive play, right? If I can't serve my customers in this way, they're going to go elsewhere to be served how they want to be served, and they're never coming back, right? So a lot of what we're hearing so far is on the defensive side, in terms of like, we need to figure this out, because once these depositors leave, they're a flight risk on a larger scale.
And Vinny, I'm curious, this is such a topical, newsworthy issue. Are you seeing fintechs coming to you and asking, hey, what banks can we work with to do this stablecoin thing? Or what are the questions that you're getting?
We've had clients or prospects before that have come in and had elements of cryptocurrency. Now we're, and we never really worked with those just based off the risk appetites of our banks, which at the end of the day control the type of clients that we choose to work with. Our product team is now currently building a real-time payments, and we're kind of figuring out whether we want to go down the RTP or FedNow route. And our more intrepid product people are spending their weekend hours, I think, looking into how we can incorporate stablecoins as well. So I think, the clients that we get are always going to be more of the tech-forward companies. So if stablecoins and tokenized deposits are sort of at the forefront of that, then sooner or later we're going to have clients that are looking for that. And so we want to make sure we work with our banks to see what their appetite is, and not just, we're big believers of not just dumping a new feature into our bank's lap and saying, hey, here, check it out, we built this. We make sure to involve them very early on in the process and let them know what we're thinking about and how we want to do it, so that we know whether or not they're going to be interested, and if they are, how they can assist, and what things we need to be thinking about as we're building out these new features.
Kind of a similar question to you, Jimmy. Stride doesn't just work with Chime on kind of the neobanking side. You do a lot with real-time payments and paying out for DoorDash drivers and things like that. So are those large corporates asking questions about these digital assets?
We're hearing, I think what Vinny was saying, we're hearing some grumblings, I'd say. It's not, the real-time payments side of it, if you think about money movement, when we all talk about Venmo and, you can get your money in 3 days, you can get it immediately for a fee, those products exist, and we support those P2P, account-to-account transfers. But it's not, we're not hearing the demand for a stable coin right now, right? I don't think people understand the use cases of them. I think that if if consumers start to figure out that they can do, cross-border with it, sending money home and reducing the cost of that, I think that's when you're going to start to see some real demand. But I don't think those products are in market yet at the level or at scale to where we're getting a lot of demand for it right now.
Okay. And Chris, you mentioned on our prep call that banks have about 18 months, starting now, as legislators are implementing the Genius Act. If a $5 billion asset community bank asked you today, what should I be doing about stablecoins, what do you say to them?
Yeah, I mean, as we were hearing earlier this morning, and I need to clarify, if you want to issue a stablecoin or a tokenized deposit, you don't have 18 months. Like, that race is on right now. If you want to gain, I mean, you're building a network. So if that's what you're thinking from a strategy perspective, the time is now to start with partnerships. Sorry.
Just a smaller community bank.
Yeah, okay, thank you.
What do they need to be prepping for,
yeah,
thinking about?
The asset size of the bank, banks are snowflakes essentially. I mean, you can look at it from an asset perspective, you can look at it from a customer perspective, but the reality of it is you really have to look into, the payment flows of a given bank. I mean, there's a smaller bank in Southern California that I've been talking with. They're about $1 billion in assets, but they're in a corridor where there's a high, remittance flow, dollar mex. So that is a bank that should be talking with MasterCard Corpay. They should be talking, potentially with Circle, with Ripple, and figuring out what is the right way to maximize, improve the customer experience and maximize revenue.
More partnerships.
And actually, just on that point, Silvergate, we built a customer-facing API gateway because there was nothing in the market that would satisfy our needs. We very rarely built something. I mean, it was, go out and get a payments hub. And frankly, these are not mutually exclusive. I mean, one of the things you get with a payments hub is the ability to do what's called a core selection on a payment flow. So you can take a payment request from a client and derive the settlement path and say, oh, for this one, I'm not going to hit my Fiserv subledger, I'm going to hit my unit subledger. So, the payments hub is about giving you optionality. And frankly, I think, part of the curse of living in the, and operating in the land of the world reserve currency is we have not, for the most part, especially smaller US banks, have not had to build out these complicated correspondent networks to settle in a bunch of different currencies and then subledger, on the back end based on different currencies. And that is the world I believe we're heading into. Like the model of a stablecoin or a tokenized deposit, to the extent you're in that network, the model is correspondent banking. The vast majority of banks in the US don't have connectivity with SWIFT to be able to interact with a correspondent bank in a mature manner. They have a point-to-point integration with PNC or Wells Fargo to do all of their FX and all of their international payments, and then they're done with it. So.
Okay. All right, we're gonna kind of wrap up with a few questions here in our last few minutes. Going back to partnerships, Jimmy, embedded finance and BaaS, what are the signals that a bank is ready versus a bank that should wait?
Well, it again, starts with your board, it starts with your strategic plan and making sure that everybody is on the same page because you're gonna have to make some investments. And so your board needs to be on, aligned, your strategic plan needs to show it, you need to have a true culture of compliance, and then you need to start working with your regulator, explaining you don't have to ask, but you need to explain what you're doing. And so I think once a bank is committed at that level, then they're ready to move forward. And if they'll build a good foundation that they can scale, I think that's the other important part, is be careful, because the dog occasionally catches the car. And so you really need to be ready for that volume if it hits you.
Yeah, because you have no way of predicting who's going to be the next Chime that's going to grow incredibly.
And I don't think that fintech is necessarily, I think that that's one of the things when we talk about the shiny object. Partnerships at whatever level, whether you're using a third party to work with you or you're using a true fintech partner, I mean, that's, making sure your bank is of the mindset. I was talking with somebody earlier, BSA officer, right? If your BSA officer doesn't understand the difference between a partner and a vendor, you have a real problem. Because there's a culture there that you have to work with your partners. You're not going to dictate to them, but you also need them to comply with whatever the banking, whatever the particular banking requirements are.
Vinny, same question to you, but from the other side, what are signs that a fintech is ready to be a good partner, or red flags that you should run away from as a bank?
So we have a playbook for the go-to-market team or our sales team that kind of outlines these red flags. And one of the red flags on there says specifically that, like, if the fintech that you are interviewing or vertical SaaS company starts talking about, hey, we want to find a bank that's not going to get in our way and let us kind of innovate and do what we want, that's not a bank, that's not a fintech that we're even going to introduce to the client. We always stress that while the banks that are in this space obviously are tech and innovation forward, there are still regulatory requirements, and they still have, we always say to fintechs, it's not if a bank exam happens, it's when it happens. So we want to make sure the banks are prepared for that. And so it's all about finding the fintechs that understand that the bank is in charge at the end of the day, and they need to be ready to take on the responsibilities that come with offering financial services.
Yeah, and thinking about it in sort of a Eisenhower matrix, right? Innovation hides in the important, not urgent category. Where I see the world moving is that upper right quadrant starting to bleed into the urgent and important movement, right? So looking at how banks are preparing for this, right? I think during Bazapalooza, it was a little bit of that Spider-Man meme of whose responsibility is it, right? And so now I think that we've lived through it and we've seen some of the enforcement actions. I do think that, where innovation hides in the important, not urgent, I think that's starting to bleed into that important and urgent in a way that we haven't seen yet.
And Chris, you talked about some of the banks that should be looking at, let's say, stablecoin for remittances, if that's a big part of their business. For the vast majority out there, do you think that it's okay to kind of sit back and wait for our main core providers to offer a product?
Yeah, I mean, specific to stablecoin tokenized deposit, I think it's a decent play for banks to wait to be receive only, and then certainly for smaller banks. I do think if you have not updated your payments layer, you should seriously be looking at that, because what I just said, the reality of it is it's not just about payment. It's not just about stablecoins and tokenized deposits. You also have to do RTP and FedNow. You also have to integrate your card. You have to be able to operate in this world as we move forward. So. Every bank should be updating their payments layer is the bottom line if they haven't done it in the past 20 years.
Got it.
Moving from one core provider to another and just switching one wire system to another, if all you can do is FedWire out of that system, that doesn't count.
It doesn't count. All right, Emmett, final words from a risk and compliance perspective. Before a bank takes on any of these business models, what's the foundational thing that you think they need?
Yeah, I think it's Jimmy's hammered it home, and I agree, right? It has to start at the board and the executive level. This is not a side of the desk, and making sure that your vision and your activities, your strategy are aligned in a way that will let you win, right? Where to play, how to win, and align your resources against it. Banks that aren't willing to sort of make the commitment up front to succeed and win in that space, I think we need to be a little bit cautious of, but based on the conversations I've had with several of our 450 odd FI clients, I think we're starting to get to a place where this partnership flywheel is gonna take off in a way that I think benefits everyone.
Awesome. All right. Well, Emmett and our panelists will be around after this and at the reception after if you'd like to continue the conversation. We have just a few minutes before the closing keynote from Brent and Ira. It's going to bring the house down, so get yourselves situated. But before we do that, please join me in thanking our esteemed panel.